Canadian farmers and agricultural producers face a unique set of financial needs, tax obligations, and opportunities. With the continuous changes to tax rules, it is crucial for those involved in the agriculture industry to be aware of tax considerations that can affect their bottom line. I will provide an overview of the essential tax considerations for Canadian farmers and agricultural producers, and how they can optimize their tax obligations to maximize income and minimize taxes. Income splitting is a common tax planning strategy that can provide significant tax savings for Canadian farmers and agricultural producers. By transferring income to lower-income family members, they can save money by reducing their overall tax liability. Farmers can employ various income splitting strategies, such as paying reasonable salaries to family members for work performed, transferring assets to lower-income family members, using a family trust to distribute income among family members. Canadian farmers and agricultural producers have the option of reporting their income and expenses on a cash basis rather than an accrual basis. Cash basis accounting allows farmers to report income when it is received and expenses when they are paid. This method can provide significant tax advantages for farmers, particularly in years when commodity prices are low or expenses are high. However, it is essential to consult with a tax professional before choosing this accounting method, as there may be limitations or drawbacks to consider. Canadian farmers and agricultural producers can take advantage of several tax deductions and credits that can lower their taxable income. Some of these deductions and credits include Capital Cost Allowance, CCA, for depreciating assets such as buildings, machinery, and equipment. Interest expense deductions for loans used to finance farming operations. Input tax credits, ITC, for GST, HST paid on eligible expenses. Scientific research and experimental development, SR and AMP. ED tax credits for eligible research and development expenses. The Canadian Agricultural Partnership (CAP) program offers cost-shared funding for producers who implement eligible projects. The Lifetime Capital Gains Exemption (LCGE) is a significant tax advantage available to Canadian farmers and agricultural producers. The LCGE allows eligible individuals to exempt up to $1 million of capital gains on the sale of qualified farm property, including farmland, in their lifetime. Proper planning and structuring of the farm operation is critical to maximize the benefits of the LCGE and can lead to significant tax savings in the future when considering selling or transitioning the family farm. Succession planning has significant tax implications for Canadian farmers and agricultural producers. When transferring farm assets to the next generation, careful tax planning can help avoid or minimize taxes on the transfer. Some tax considerations when planning for the succession of a farm include structuring the transfer to qualify for the LCGE, considering the use of an intergenerational rollover to defer taxes, utilizing farm partnerships or trusts to facilitate a tax-effective transfer, preparation of a will to ensure that farm assets are transferred as intended and in a tax-efficient manner. Given the complexities and unique tax considerations for Canadian farmers and agricultural producers, it is essential to consult with an experienced tax professional who understands the agriculture industry's nuances. By focusing on tax planning strategies, farmers can optimize their tax obligations and ensure their business's financial health and future generations' success.